Part 3. Leverage and Money Management. The importance of risk management and leverage. In trading, leverage allows traders to amplify their risk and reward ratio with a simple click of a button. By increasing leverage, traders can potentially grow their gains or losses exponentially. However, it's crucial to manage risk based on the trading strategy and define the variables carefully. For instance, our extensive 15-plus years experience has led us to determine that risking less than 1% of our balance per trade is the ideal approach. This way, even if we're trading systematically, we can avoid putting most of our capital at risk, which is something sophisticated traders and billionaire firms must do in order to succeed. It's essential to view trading in terms of percentages, because a 1% risk can represent varying amounts, from a few dollars to potentially a few billion dollars, depending on the balance size. By organizing our strategy this way, we quickly realize that a balance of 100K or more is the only way to ideally risk a few $100s at a time. Trading systems aren't designed to double or quadruple your money quickly. Instead, they focus on making small, consistent gains over time. By adhering to exact rules and following an exact strategy of entries and exits on a daily basis, traders can operate their trading like a business and scale accordingly by repeating the same steps consistently long-term. Important tips related to risk management and leverage. Leverage allows you to amplify risk and reward ratios, but it should be used wisely to manage potential gains or losses effectively. Risking less than 1% of a balance per trade is ideal to avoid significant capital risks. Treat trading like a business by following exact rules and parameters.